and I heard about people itemizing their deductions. I thought that they were compiling. What? No. Okay, sorry. I thought they were compiling like a list, like this giant long list of every individual thing that they were deducting. You know, and they say keep all your receipts and everything. And so I thought they had to like write out every single item that was on every single receipt. That's not how it works. We'll go over how it actually works. But we practice in this country something called voluntary compliance. And that is where we cooperate with the tax procedures set forth by the government. Now, it's kind of, if you don't pay your taxes, they're not going to come banging on your door. Like taxes are, you have to mail them by April 15th. So if they don't receive them in the mail by April 20th, they're not going to come banging on your door and haul you off to prison. That's not how it works. You get assessed penalties and fines. You can get jail time if you continue over, periods of time to perform tax evasion or do illegal things. But for the most part, what happens if you don't comply is that they say, okay, well then you owe us more money. And it's a lot. It's, penalties and fees aren't small, they're giant, to try to encourage you to comply. With the 1040, this is the original form. This is the long form. Anybody can use this form. So you know how the 1040EZ had very specific restrictions, and then the 1040A is for people that aren't itemizing, but less restrictive. With the 1040, it's everything else. Anybody can use it. It covers every scenario. Usually, because it's a more complicated form, the only people that tend to use it is if you have alternate sources of income, you own your own business, you're self-employed, you are a farm worker, or you have multiple accounts, or it just like unusual, not I go to work and I get a paycheck. Or if you have other kinds of unusual circumstances, maybe you come from old money in Europe, and so you have a lot of foreign investments or foreign. You get you get a 1099, so that's considered self-employed. So you could fill this out for that as well. You'd want to fill this one out because you have to attach the Form SE for being self-employed. And then, or you use this form if you're itemizing your deduction. So you're choosing not to take the standard deduction of that. It's like 9,000 if you're single, or no, it wasn't 9,000. Sorry. If you're on a 1040EZ, it's 9,000. If you're doing a 1040A, it's like 5,900. And if you're married, it's 11,000. So if your itemization would be higher than the standard deduction, then you itemize. You want to pick whichever one's bigger. Okay. Deductions lower your taxable income, so they get subtracted out of your income. So if your income's 20,000 and you have $10,000 worth of deductions, you do 20,000 minus 10,000. Now you only pay taxes on $10,000. Okay. That's why you want to pick whichever one's bigger. And then we're going to go over what things are allowed to be deducted when we go over that Schedule A, which is the itemization form. The Schedule A is the form that we use. You should have them. Schedule A. And we use these for itemizing deductions. And we'll talk about what you can keep, what you should keep track of, what you can deduct. Okay. Okay. Tax credits. Deductions get subtracted from your income. Tax credits get subtracted from the amount of tax you owe. It's a credit that it's acting as if you've already paid that amount. Really common ones, child tax credit, earned income credit, both have to do with having children. Earned income credit has to do with how much income you made versus the size of your family. There are education tax credits. There are veterans tax credits. There's all kinds of tax credits. And then you have tax avoidance versus tax evasion. Yeah. No, you do have to pay taxes. Mm-hmm. Yeah, you do have to pay taxes. Um, you have tax avoidance and tax evasion. Tax avoidance is using legal means to lower your tax bill. So deductions, donating to charity at the end of the year to have some deductions to throw in there, um, keeping track of your expenses and things that are deductible expenses so that you can do a higher deduction, or getting credits like filing for earned income credit or child tax credit, things like that. These are legal. Tax avoidance is legal. Tax evasion is illegal. You remember Al Capone? Yeah, they never got him on all the mafia garbage that he was doing, right? You knew that. He went to jail for tax evasion. That was the only thing that they could get him on. They could never prove any of the other stuff. Tax evasion is illegal, and tax evasion is when you lie. And this can come into many forms. You can lie about having dependents that you don't actually have. There was some guy that claimed his horse on his taxes as like a child. Not his kid. That's illegal. I know, I think, well, I don't know. But if you lie about your income, let's say you're self-employed and you made $200,000 last year, and you go, you know what, I only made 100,000. It's possible. There's records. Everything's electronic now. Everything. So, I mean, yeah, you can get caught. Okay, so lying on your tax form to lower your tax bill is illegal. Lying about dependents, lying about the amount of income you had, lying about credits you qualify for, any of that, illegal. So, anyway, it's a felony. That's how they got Al Capone. All right, so we're going to do a 1040, and we're going to do a Schedule B and a 1040 at first, and then we'll get into the itemizing the deductions. So we'll start with non-itemized. And then, no, we are doing a 1040 and a Schedule A and a Schedule B. So let me pull all this up. Okay, so these are the forms you guys need. Schedule A, Schedule B, and 1040. Everybody got them? Okay, so we've got Margaret and Brian O'Sullivan. Okay, so their names go on there first. And they have one child, Carol. And she's their kid. And we're going to go ahead and check that off. Now, they're married filing jointly. See, they're married. So we're going to check off that they're married filing jointly. And we have Brian and Margaret and Carol. So Brian and Margaret and Carol. Now, I don't think I mentioned this yesterday, so I want to go ahead and mention it. If you have other dependents other than your child, let's say your parent lives with you and you're taking care of them, they still go on this line under dependents. You put down like mom or mother or whatever, and you don't check off that they're a kid. And they don't go on this line where it says children. They go on this line where it says dependents on 6C. That's all these people, not listed above. So if you had like one child and one parent, they would go here and here. Does that make sense? So this is kids. This is people that didn't live with you for divorce or separation and see instructions. And then this is people that lived with you that aren't your kid. Okay. So we've got married filing jointly. They've got a child, so they have 3 exemptions. He still gets listed up here, and he still counts into one of these. So what happens is anybody that's married, like if only one person's working, it doesn't really matter because the income gets combined anyway, but the spouses get listed up here and get counted here. So they don't get listed, spouses don't get listed down here. They go up here, whether they're working or not. Well, there is a difference, yes, but they still go in the same spot. Huh? It doesn't matter, they still go up here. Because they still are counting as an exemption, right? Because you're here and here, so they're still getting counted as an exemption. So you get counted as an exemption, your spouse gets counted as an exemption, and then any other dependents also count as exemptions. Okay, so that's that part. Now we get into the income section. Now you guys, I do want you to look at these forms because they tell you line by line what the line is for. So I mean it does walk you through it to a certain extent. So okay, we have combined wages of $76,521. So we have $76,521 combined wages. And then look, they have two banks, Seaford and Buffalo. Okay, so now we're going to have to go to the Schedule B. Okay, so we're going to go to the Schedule B and fill this out. We have Seaford Bank and Buffalo Bank. Okay, Seaford Bank was $812, and Buffalo Bank was $877, and then those get added together. It would be nice if I actually. Good here. Okay, so we add those together. Excludable interest on Series EE and U.S. savings bonds. We weren't told anything about EE or U.S. savings bonds, so we're not having excludable interest. But if you had a savings bond, certain ones are tax exempt, and that would go here, and then you would subtract those. But since we don't have that, that's the total for the bank interest.
What was that number?
1689. Okay, sorry. So on this form, you just list the names of the banks and list the amounts and then add them up. Okay, that goes on taxable interest line. So 1689 goes right here. And the next thing we have, tax exempt interest, we didn't have any of that. So then we have ordinary dividends. We have two sources of dividends. We have GM and Kodak. Okay, so same thing. Now we're on dividends. So I have GM and Kodak. List the companies and then the amounts. 444 from GM, 1,200 from Kodak. Add them together. And then we have to answer the questions in section 3. Okay, did we have financial interest at another country? We're going to say no because we're not being told that there are any foreign transactions here. So no, none of these are foreign transactions. GM and Kodak are American companies. These are American banks. You're good. Okay, any questions about that part? Okay, now I take this 1644 and that goes on line 9. And this Schedule B would then be stapled together in the packet when we're done. Like with the 1040, you just staple everything together at the end. So we just set it aside. We're done with it for now. Okay. As we go down the list, we can see there's taxable refunds, credits, or offstates from state and local income taxes. Now, you can deduct state and local income tax if you're itemizing your deductions, But then if you get a refund, so let's say last year I deducted my state income tax, but then I get a refund, I have to put the refund here because that has to be the correct balancing out. We don't have to worry about that because we don't have state income tax. Okay. If you receive alimony, now you do not have to pay tax on child support. So if you receive child support, you don't pay taxes on that, but if you receive alimony, you do. Business income or loss, this is if you're self-employed, or not self-employed, but you own a business. Capital gain or loss, again, if you own a business. Other gains or losses, owning a business. This section here, IRAs and pensions, that's if you're retired. If you own real estate, or you earned royalties, or you're part of a corporation or a trust, you have to fill out this Schedule E and you put the money that you earned there. If you own a farm, your income or loss goes here, and then you have to attach the Schedule F for farm. If you earned unemployment, that goes here. Let's just double check that. I don't think they had any unemployment. No. But Margaret did win the lottery. Okay, so unemployment, it would go here. If you got Social Security benefits, it would go here. Other income. She won the lottery. If you win the lottery, you're supposed to pay taxes on it. Now, is anybody going to come get you for that, like, $10 scratch off? No. But if you have, like, a significant lottery winnings, it gets reported. So just, so you know. If you win, like, a really big one, it depends on how you do it. If you do the annual disbursements, they don't automatically take it, I don't think. Okay, so then we add everything up on this whole list, and we get 80,154. Okay, that's our total income. That's our income section. Next, we have adjustments to our income. Okay, educator expenses. Remember that I told you guys yesterday the max on this is 200. You can't claim more than 200. Margaret teaches night course, and she had 133 in educator expenses. That's below 200, so she can claim all of those. Okay, certain business expenses. If you are a reservist, a performing artist, or a fee-basis government official, you can attach Form 2106 and you can put the expenses here. Performing artists, this is for their, like, supplies and stuff. Okay. If you put money into a health savings account and it didn't come out before taxes, that can go here. Moving expenses, you have to attach a form 3903. We're not going to actually do that form, but it's a very straightforward form. But look, they did have moving expenses, $3,009. Those go right here on line 26. Okay. If you have one of these qualified plans or self-employed health insurance, if you're self-employed, you would have the forms to do that. If you withdrew money from a savings account and had a penalty, for example, like if you take money out of your retirement account before you hit retirement age, you get charged penalties on it, or if you pull money out of a CD, you get charged a penalty, you can deduct the penalty. If you paid alimony, the person that receives the alimony has to pay the taxes on it. You don't have to pay the taxes on it. So if you pay alimony, you put it here and you put their Social Security number right there and tell the IRS, yeah, you go get that taxes from them. If you put money into an IRA after taxes, if you paid student loan, if you had tuition and fees, you get a 1098 again from the college, and you fill out this form 8917, and it tells how much you can deduct. Now, you cannot, if your tuition and fees are covered by scholarships or grants, you can't deduct it. If the scholarships and grants cover the total amount, you can only deduct what's not covered by a scholarship or a grant.
Call the IRS instead of them calling you, just be like, hey.
For what?
Just like, you
Yeah, you can.
You can?
You can totally call them. They have a 800 number. Domestic production activities, just this is if you're producing things domestically, like you're in manufacturing or something, and you're producing inside the country, you get a tax benefit for that if you own your own business. And then you add these lines together, and you get 3142, and then you subtract that from your income. And that gives us an adjusted income of $77,012. Any questions on the adjustments? Now, for your purposes, the only things that you guys will see on your assignments, you will have possibly educator expenses, possible moving expenses, and possible of those. I'm not going to give you any of the other scenarios, okay? And just remember, 200 is the max. So even if I tell you they had like $500 in educator expenses, you can only deduct 200. Yeah, sorry. Okay, so 7712, we bring that to the back. None of you were born before 1948, and none of you are blind, so you don't check off anything there. Pi r square. Okay, now, standard deduction for married filing jointly would be 11,900. If your expenses are high for the deductible allowable things, you want to go ahead and itemize and see what the total is, because you want to pick whichever one is bigger. So let's look at, we have 18,800 medical expenses, so they only pay 20%. All right, so they had 18,800, but their insurance covered 80% of it. So they only paid 20% of that. So we're going to take 20% of 18,800 and find out what that is really quickly. So 3,760. Okay, so let's go to our Schedule A. Now, I'm going to zoom out really quickly. I'll zoom back in, but okay. Schedule A is broken into the areas that are deductible. You have medical and dental, taxes that you've paid to other entities other than the federal taxes, interest that you paid on certain things that are allowed, gifts to charity, casualty and theft, job expenses and certain miscellaneous deductions, and then you have other miscellaneous deductions, which there's a list of possible things that are deductible. We're not going to go through all of those, but if you go, like if you look at the Schedule A instructions, there's a list. But these are more rare. And then you total it. So we're going to go through this section by section, and so here we have medical, okay? Now, do not include expenses reimbursed or paid by others. That means you can't include the part that the insurance paid. Also, you cannot include so if you have a flex account that pays for your doctor or whatever, anything that you pay for out of the flex account, you cannot count as part of these medical expenses because that money was already tax-free. Okay, so we're not being told that Margaret and Brian had one of those. So we have their amount, which was 3,760. So that goes right here. Then you take their amount from 1040, line 38. That is their adjusted gross income, the top of the back page. So $77,012. Okay. You have to multiply the income by 0.075. And that's right here. Multiply line 2 by 0.075. and you get $5,775.90. You are only allowed to claim the amount of your medical expenses that are over 7.5% of your income. The government expects you to pay 7.5% of your income, like that's how much they expect you have to pay without getting a tax break. It's only the amount over that. So if 7.5% of your income is 5,000, but your medical expenses were only 3,000, you don't get a medical expense deduction. So that's zero. If this amount here was like 8,000, then you subtract those two and you can claim the difference. Does that make sense? Okay. So that's medical expenses. That's how that works. And now that's not just doctors, that's all medical expenses. So that's your doctor's visits, any prescriptions that you had filled. It does not include over-the-counter medications, unfortunately, but if it's prescriptions, you can keep the receipts for all your prescriptions, all your doctor's visits, dental visits, eye doctors, eyeglasses, braces, things like that. Okay, so anything that was actually from a doctor. So eye doctors count too. So chiropractor, yeah, that'll count. Chiropractic counts. So eye doctors, chiropractors, medical doctors, prescriptions, dentists, any specialists like podiatrists and, all those people too. So, medical, pretty much anything medical. So if you're having a lot of medical expenses during a year, keep the receipts. Just keep a box, a shoebox or whatever, an envelope, keep all the medical receipts, add them up at the end of the year and see if you can deduct them. If you can, you can. You don't pay tax. You're allowed to deduct state or local taxes. So if you pay state income tax, you can deduct that. We don't pay state income tax. However, we pay sales tax. If you want to, you can keep every receipt from January 1st to December 31st, and you can add up and deduct all of your sales tax. Now, your standard deduction for a single person is $5,950, so you'd still need all of this to add up to more than that to make it worth your while. But if you're close, the sales tax might be enough to push you over that edge, So I keep meaning to do this, but I haven't done it yet. But keep all your receipts and you can deduct your sales tax. But with the Sullivans, now you can only do one or the other though. You can only do sales tax or you can only do state income tax. You can't do both. See, that's why it says or right there. And the Sullivans have decided to do their state income tax. They have $3,298 in state income tax. So they check off income tax and put that $3,298 right here. And then real estate tax, that's property tax. You can deduct that as well because that's a state tax. Personal property taxes, this is taxes that you pay on personal property. So you can actually deduct the tax when you buy your car. You can deduct the tax when you buy a camper, like personal property, not land. Other taxes, we don't really have a lot of other taxes, but if you had other state or local taxes that you had to pay for whatever reason, you can list them here and you can deduct those. Okay, now if we look over here, the next thing they have is mortgage interest, but that's interest, not taxes. So we're done with the taxes section, so we're adding these two together. Now with taxes, you get to deduct the whole thing. Whoops. So you add those together, don't subtract them. So they get to deduct $6,865 for that. Okay, interest. You cannot deduct your mortgage, but you can deduct your mortgage interest. And you'll get a form from your lender when you have a mortgage telling you how much interest you paid that year. They have to send you that. And so the Sullivans had $3,096 in interest. Okay, home mortgage interest not reported to you on the Form 1098. So if you say for sale by owner, you had owner financing on your house, but you're paying interest, you can still deduct it. You just have to keep really accurate records and then say who you paid the interest to, and you can put that right here. Then you have points, mortgage points. Those will get reported to you also, and there's special rules for those. If you have mortgage insurance, now mortgage insurance is not the same thing as homeowner's insurance. Homeowner's insurance protects your homes and your valuables inside your house. Mortgage insurance is to protect your mortgage should you become disabled or deceased. It pays your mortgage for you. Not everybody has that. But if you have that, you can put that right there. And then investment interest. This is if you had to pay interest on an investment that you made. Not very common. Add those together, and that goes right there. Any questions on the interest section? Okay. Next is charity. Okay. Now, if you make any gift of $250 or more, now this is individual gift. You have to fill out another form. There's another form to fill out. So let's say you're donating a bunch of stuff at the end of the year. If you donate $250 to this place, or well, $249 to this place, and $249 worth of stuff to that place, and $249 worth of stuff to that place, and you do 3 different donations of less than $250, you don't have to fill out the extra form. It's if you have one donation that's $250 or more to a person or an entity, and you have that's cash or items. Now, if it's over $500, you have to attach this form also. And if, let's say, last year I donated to charity, but I didn't have enough to itemize last year, I can hold on to that receipt and I can claim it this year. You're allowed 1 year leeway on charity gifts. So I could claim last year's and this year's together if I have enough to deduct. Now, 2 years ago is too late. It's only 1 year that you're allowed to go back on charity. Okay. So they gave $987 to different charities, but the highest they gave to any single charity was $100. So I can just put the $987 right here. I don't have to follow the instructions because there weren't any amounts over $250. And then that's a cash, and then they donated $450 worth of old clothes. So cash or check, items. They did not have a carryover from a prior year, so we just add those together. And donations to charity are straight deductions as well. That's why people do that when their car dies. They donate it to charity because you can deduct it, the whole amount of the value of the car that they write on the receipt for you. They usually go higher than it's really worth. It's kind of nice. Casualty and theft losses, you do have to attach a form. Okay, casualty, storm damage, flood damage, fire damage to your property. So like when my house burned down, casualty. Theft is, theft. Like, so if things are stolen. So if you have any of those, like storm damage, flood damage, fire damage, you can get reimbursed, but only the amount that the insurance doesn't pay. If the insurance covers it, you can't deduct it. You can only deduct what the insurance didn't cover. So they had $92.30 of flood damage. So that goes right here. Let's just, we'll get through the, All right, then we get into the job expenses. We had $541 for travel. Now, you're not allowed to deduct your commute to drive to and from work every day. You can't deduct that. But if you have to travel for work, like you had to go on a business trip and they didn't pay for your traveling expenses, you can deduct that. But if they paid for it, you can't deduct it. And then, we have unreimbursed employee expenses, job travel, union dues, job education. Union dues are deductible. So we had $14.39 in union dues.
Wait, they had a theft. Oh, I see. Or flood damage.
Yeah, flood damage. So he had $541 for traveling and then $14.39 for union. So we add those together, and that goes right here under. Oh wait, hold on a second. And he had to take 2 college classes for $23.15. So those all get added together and go right here. Okay. If you pay somebody to do your taxes for you the year before, so H&R Block or whoever, that you can deduct that. Investment, safe deposit box, other expenses go here. Add those together. Enter the amount. Again, your income comes into play in this category, and you multiply it by 0.02. Okay, I can only claim the amount over this. So I take 4285 and I subtract the 1540.24, and so I'm allowed to deduct 2744.76. Like I said, we're going to skip this other miscellaneous deduction section. So now what you do is you take and you add up all of these numbers all the way down the list. So we had 6865, 3096, 1437, 9230, and 2744.76 for a grand total of $23,372.76. This is their deduction that they're going to get to take. The standard deduction was only $11,900. So if you have to choose between here and the $11,900, you're going to take the $23,000. And that's why it's a good idea to look at your itemization. Even if you maybe aren't sure if you have enough to itemize or not, just look at it and see. Because maybe you do, maybe you don't, but you want to just pick whichever one's bigger because that saves you tax money. Okay, so we'll stop here. Tonight, finish these that I assigned yesterday, okay? And go ahead and start looking at the 1040s stuff. You don't have to do any of that yet, but just start looking at it and kind of making sure you're getting familiar with it, okay?